You bike to work every day, Joe, yeah?
Not every day, but hopefully more than not. I did today for sure. It's gorgeous out. Yeah.
Yeah, it's been beautiful. I know, good time of summer for us. I know Skylar's been dealing with some heat from out in Nebraska.
Midwest in Nebraska. Yeah. Yeah.
Oh wait, are you in Omaha?
Yeah. Omaha, Nebraska. Yeah.
Funny, I had one of our traders is based there. He was in yesterday. We had like a firm-wide kind of leadership team meeting, and he had a trading group, and he tried to get home last night. I guess you guys had some bad. He literally called me from Denver about an hour ago. He's still there, trying to get back to Omaha.
Really? Yeah. Well, we
Yeah.
had a big hailstorm, and it was weird because it was like coming home. It was 103 degrees on my gauge in my car driving home, and then we had this crazy storm, and then it was a 2.5-inch hail, baseball size hail hitting certain areas of the city. So it was kind of a crazy deal. Sirens were going off. We were like,
Was that last night?
yeah, last night. Yeah.
He said the plane they took off and they just went right over Omaha. I'm like, nope, we're not going. We are not going through that. So they just sailed right over Denver. Yeah. Oh yeah, totally.
That's funny. Well, yeah, weird weather. We're having weird storms here. Last couple of days, it's been really hot and humid. I mean, we get heat here, but really unreasonably so, which is kind of not the norm for us at this point in time. It's not even July yet, and it's really hot.
Yeah.
Yeah. Yeah, you were saying like 110 the other day, yeah?
Yeah, with the heat index, it was brutal.
Jeez.
Oof.
Yeah.
That's not good.
Well,
Not good on
might
it.
be Atlanta, or
Yeah.
Yeah.
Yeah. Except
Oh,
you can't even say it's a dry heat.
no, we can't. Wish we could. Nope. You're exactly right. Awesome.
Cool. Well, Joe, let's jump into it. Tell us a little bit about why don't you start with your background? Walk us through your background. Kind of bring us to where you are today.
Yeah, happy to. Thanks, Michael. Thanks, Skylar. I think, just in terms of background, it's really Joe and my partner, Phil. When I speak to background, I have to speak to both of us because we've been conjoined at the hip since the late 1990s, 1996 or so. I came from originally, I was at IT early 90s, jumped over to an RIA, just a registered investment advisor out in the West Coast for a couple of years, and then moved to Chicago where I took a job at an institutional consulting group. And that's where I met my partner today, Phil Kosmala. And we were there together for about 5 or 6 years. Got our CFAs. Phil actually came from the SEC, so he had more of a regulatory background, which was quickly adopted into the manager due diligence and research space, obviously. So we worked together there for about 5 years. I wore a lot of hats, research hats, but started getting into relationship management consulting, institutional consulting there. That was mostly a qualified plan environment consulting firm. And then he and I actually left together and made a jump over to a firm also here in Chicago that focused a lot more on the endowment foundation space. So a lot of endowment foundation clients, and that's where I look at the first firm and really kind of look back at the time we spent there. And I feel like we learned how to run an investment consulting practice there from a business standpoint, really well run. But then the second stop, I think, looking back, we learned how to invest. How sophisticated committees put together investment programs. And a lot of the names folks would know just in terms of the higher ed endowment space and things of that sort that we worked with. So we were there together for about 10 years, just shy of 10 years, Phil and I, that is. I did in that capacity, after it was about 3 years, I really did veer over into the alternative investment lane specifically. So I did end up heading up the alts research group there at that company. We did have dedicated, relatively significant, I guess probably middle market, but pretty significant dedicated alternative investment mandates where we allocated a pretty good deal of capital to the private markets, private equity, private credit, real assets of various types, real estate, of course, infrastructure, oil and gas, timber, ag, et cetera. And then also the hedge fund side. So we really got to know our way around the alternatives landscape there at that firm. And then Phil and I, again, made a third and hopefully final leap to open our own group in 2012. So that was like roughly, '02 to 12. And then 12 through today, we launched Taiber Kosmala in 2012 with the two of us and a Bloomberg. But a lot of clients that we had built up a lot of trust with at that point that fortunately endorsed our effort at the time. And within the first 6 months or so, we had a pretty good endorsement from a good, cadre of institutional clients. We had about 30 clients join us, and that was about a $3 or $4 billion base that we were able to establish a good practice. And we've grown to what's a small, still a boutique group. We're 16 people. We are advising on just shy of 15 billion in assets across various entities. There's really two primary companies that we're running today: the dedicated institutional consulting business, and then secondly, we did form or launch a more dedicated registered investment advisor, OCIO, kind of a custom OCIO practice. Obviously related. The OCIO practice leverages the work that Taiber Kosmala has been doing for a long time. And that's kind of where we are today.
I'm curious, before we jump into it too much, tell us about the name. Where did Taiber Kosmala and the other company is Tyco Dynamic? Is that correct? I'd love to hear about how you guys came up with naming these.
Well, we're not very creative. Joe Taiber, Phil Kosmala. So yeah, that's like any law firm or whatever out there, professional services firms. So yeah, Taiber Kosmala is just our last name, and then Tyco is Taiko is again not very creative, but there was some fun there in the sense that Tyco is Ty Kosmala, of course, Taiber Kosmala, but there's also some one of the guys who was really an architect of the technology side of that business is a drummer. And he really gravitated to, okay, so Skylar's nodding his head. He gravitated to the Japanese drummers, the taiko drummers, which are these really big guys who wear diapers and pound drums on stage, I guess, exactly. So he got a kick out of that. So we're like, okay, whatever, that's fine. That sounds like a fine enough name. So that's how we arrived at the name.
I love the backstory. That's awesome. That's really cool.
Yeah.
That's great. I'm curious. I've had some background in the OCIO space and are previous admin. Obviously, mandates and things like that obviously change from different solutions for certain institutional players. I'm curious, based on what you guys are seeing in the business today, where is that at based on the alts market? How do you guys see different strategies are playing out? I'd love to kind of get your insight there as well.
Yeah, definitely. I mean, I think OCIO, it's the concept has been around obviously for a long time, and it really incepted in the institutional space and really kind of the smaller institutional world. It's kind of, I think, swam upstream a bit into the mid-size institutional space. And our OCIO concept, we do have a few OCIO clients institutionally. We're really we stayed in the generalist, non-discretionary institutional consulting capacity for the overwhelming majority of those clients. However, because we from the beginning of the launch of those practices back, that probably goes back to like 2010 when OCIO really started to first come around. I think part of the value proposition of OCIO that consulting firms hung their hat on is, give us the keys and we'll perform better, will generate higher returns in exchange for this higher fee. And we're skeptical by nature. And I think, the value proposition of institutional OCIO translating directly to improved performance, I think that jury, frankly, honestly, is still out on that. I really do. And our clients would attest to that. Our non-discretionary consulting clients specifically would attest to that. So that's the origin of the term in the industry. We really took it into the RIA space because the registered investment advisor is kind of that, small and mid-sized RIAs. These are groups that are advising on, somewhere $150 to $1 billion, less than $1 billion in assets. And they don't have the infrastructure. They really don't have the infrastructure. And that marketplace, that industry is really, I think, come to a conclusion, and accurately so, that they're very much in the gathering objectives, maintaining financial plans, setting, expectations, managing behaviors, planning for estate planning, insurance, all these sorts of things, and building out a real investment infrastructure, something akin to or parallel to an institutional group, is A, really costly, B, a massive diversion from their core value proposition. So the OCIO concept didn't really exist there many years later. And that's why we approached that market with that value proposition. And as it pertains, Skylar, to the alternative investment landscape, yet again, I think that retail or quasi-institutional registered investment advisor industry, the alternative investment, quote unquote, products that historically and arguably still today are marketed to that segment. Us coming from the institutional saddle and the time in the saddle running, more significant institutional programs, looking at the product that really channels in the retail space, we were kind of taken aback, honestly. The fees were exorbitantly higher in a lot of cases. The quality of the management teams, the firms, et cetera, the products, just generally the products. Up until very recently, a lot of players have definitely entered into and pressed for distribution into that RIA channel on the alternative investment side. So it's getting rapidly better in terms of structuring strategies so that they are accessible to, more mass retail accredited investor type distribution. But that's really in the last, 5 years that there's been an intentional, push, in my opinion, to really enable OCIO practices with alternative investment strategies, teams, organizations, products, what you will, that would pass the diligence of what we're doing on the institutional side, of our businesses. So really been an exciting evolution for a segment of the population, massive segment of the population that, has really kind of been neglected, I think. And the alts industry has responded pretty greatly, I think, in the last few years.
Yeah, that's definitely a unique perspective. And obviously the RIA space is to your point, I'm assuming this is the case, but you can tell me if I'm wrong, but obviously they're pulled into many different directions based on their current, infrastructure, resource constraint at certain times. To have a party like yours and program to come in and say, just focus on what you do best and let us come in and do the due diligence and infrastructure. We know what we're doing and kind of help you, guide you down this path. That probably saves them a lot of time as well, I would assume.
Tons of time focusing on their core value, but even competitively, if you think about it, I mean, it arms them or equips them pretty well to compete with, the wirehouse advisors, the wirehouse teams, the brokerage teams, the Merrill Lynch's, the Morgan Stanley's of the world. They're out there, the Goldman Sachs's of the world. They're out there with a centralized, manager research office, back in New York. That's blessing product. The criteria for a lot of those wirehouses to bless products, we can leave that for another conversation. But they are at least generating the due diligence and the reporting and the monitoring and the oversight that their advisors need. These independent RIA channels, they have platforms. They're all that. Of course, there's alternative investment platforms, but they're kind of like a customer kind of walking around a Home Depot without much knowledge or expertise. When you go to a lot of the platforms that have made product available, but don't really have the guidance or the expertise to be able to navigate it. So our idea of complementing the product and of the retail platforms that do exist with the organic efforts of our institutional group that has tons of product that would never entertain distributing through the retail channels, through the platforms, the retail-oriented platforms that are out there. Marriage of those two things, and equipping that, advisor with, not to break my arm patting ourselves on the back, but a pretty, experienced group to be able to compete with a centralized research group, wherever they might be. And so with a flip of a switch, a $500 million independent RIA has a purely objective, no pay to play, very disciplined, experienced research group standing behind them to be able to go out and compete against a insert wirehouse name, advisor or broker, out there. So yeah.
Yeah, well, that's interesting.
Good.
Yeah, sorry, go ahead, Mike.
I was gonna say, yeah. Thanks for getting into that. It makes a lot of sense. I'm curious. Kind of. Maybe we could start with the RIA side. Talk to us about the offering. Let's get into some details from there. But I'm curious, just kind of, what it looks like in terms of a platform for these folks.
Yeah, definitely. So the offering to that business. So Tyco is in what I call a custom OCIO business model. But Phil and I, me coming from the institutional side, we needed a lot of help to understand how to what technologies lend themselves to that segment of the industry. What service model makes sense to that segment of the industry? I did spend time in an RIA, but that was 30 years ago, right? So it's one of those things that we took our investment knowledge and married it with the right people, bolted on the right people, the right expertise from a technology and trading standpoint. So the offering is pretty clean. It's an OCIO offering that approaches that independent RIA and says, look, we're going to build your platform, not come shop off of ours. We are going to build yours in collaboration with your investment committee. So a true OCIO process, not we aren't a platform that comes and says shop our product. So what actually happens there, the nuts and bolts or the scaffolding that we've set up, is we start with a blank canvas and we look at both the traditional side of what they're doing, traditional investments and what they're doing. That might be, looking at their long only, stock bond, cash models that they're employing, helping them, equipping them with detailed performance and risk attribution on active managers that they have on that side of the portfolio or that side of their investment program. And then separately, we look at what they're doing in the alternative investment side of their ledger, whether that's real estate or hedge fund or whatever it is. And then we literally construct a blank canvas platform that is just for them, branded just to them, that they come in through a user interface. They come in through user interface and interact with our trading desk, our ticketing system, our staff to place client assets in models traditionally. So we're actually trading into those positions. We marry these models. And one really interesting thing that we're doing is we're marrying separately managed account model delivery. This is on the traditional side with, mutual funds and ETFs. So we're building custom models that blend individual equities with ETFs. So you get real great tax efficiency, low cost. And once again, we're leveraging what we're doing on the institutional side as an example. So we're getting model delivery from equity firms, so long only equity shops that aren't on any platform. They had no interest in retail distribution, but because we have institutional business with them, they will model deliver to our boutique little custom OCIO platform. So there's product differentiation, there's full customization in terms of what the models look like, how they're managed. And we are actually doing the management, the daily rebalancing, the tactical rebalancing, the strategic rebalancing, manager research and due diligence that stands behind all of the managers, both traditional and alternative. So that's comprehensive quarterly performance and risk evals of all active managers and alternative managers each quarter, documented for their investment committee, reviewed by their investment committee with us. Again, my partner is a recovering SEC examiner, so he has a pretty good idea of what their files and records and responsibilities are as advisors. So all that is really custom tailored though to each individual client. So we're kind of taking that consulting DNA, that institutional consulting DNA, and applying it to that RIA industry to build these platforms for these clients.
Yeah, definitely. That I'm assuming that just from a market positioning, getting your guys' insight, and also from a competitive analysis standpoint, they don't know what they don't know, but you guys kind of coming in and saying, hey, here's what the real-time landscape looks like. Here's how I can help you position your specific program in this ecosystem, I'm sure is of great value. given kind of where they dealt with things in the past and where they're at today, right?
Really is, yeah. It's a competitive advantage. It really is. I mean, whether it's product that they're not going to be made available. It's product that's not made available to their channel readily. That's differentiatable or differentiated, or just the fact that they're able to bolt on, the scale of a team like ours to compete. I think and I know this is an alternatives funds focus, conversation. So I think one of the things that I think is, really just, I don't know, beneficial being where we are and being where technology has evolved relative to the industry is just the ability for us to relatively inexpensively, create, master feeder vehicles to be able to distribute across these firms. So, of course, we're not going to design a master feeder fund structure for a single $200 million RIA that might allocate $5 million. So we're going to approach, do the due diligence, approve this, whatever it might be, approve this GPLP fund structure, and have it structured, managed, administered across the, roughly 30 different firms, RIAs that we work with around the country. So then the number starts to make sense in terms of the allocations. And we're still early on the alternative side. We have packaged 3 funds and distributed them across that ecosystem, that kind of RIA ecosystem. But we look forward to doing a lot more as we evolve, because it's one of the most common questions we're asked, by advisors is, what do we do? And they get pitched stuff all the time. And of course, now we are their firewall to diligence things and kind of really vet out what makes sense and what doesn't. But we're also a sourcing agent. We are their sole sourcing agent, as well. So bringing product to them is key.
Yeah, that's really interesting. I'm curious, just what types, like when RIA coming to you guys, when does it make sense? What's the criteria? What do you guys look for? What are the pain points that lead them to your guys' program, or at least partnership, if you will?
Yeah, but I don't know if there's one profile. I mean, from an asset perspective, these are, generally, like I said, about 150 million. The largest RIA that we work with is probably just shy of 1.5 billion. So I call that small market, because at some point, when you get well north of $1 billion, you're going to build out the investment infrastructure yourself. Right. We understand that. So I'd say it's a firm that doesn't have maybe the economic wherewithal or the appetite, frankly, to hire, fire, rehire, like replace, manage investment infrastructure, a full investment team. So it's that profile, and that does lend itself to that small and mid-size, independent, RIA. But I think even more than that, it's a firm that has the view that their value proposition is what we described earlier, which is very relationship centric, planning centric, and leaving it to our collaboration to cultivate and weed the garden of their investment program collectively, such that it really reflects what they want to be out there in the marketplace, quote, offering, so highly passive, for instance, highly passive, super tax efficient, very low cost. If that's really what they want to be out there competing with, awesome. We could build a robust platform of, direct indexing solutions next to, maybe some tactical, more rifle shot tactical positions to demonstrate some value add, well researched. That's the other thing. I mean, our research budget, our just macro and fundamental and economic and geopolitical research budget is significant, obviously. So, and us fueling that, across or leveraging that across that independent RIA channel really equips them with a lot of stuff, that they otherwise probably wouldn't. So again, that's the feeds of the economic side.
Yeah, and when you guys work with these different RIAs, because I assume as an RIA is working with, maybe if Skylar and I were clients, obviously our investment portfolios are probably going to look a little bit different. Just as yours would also look a little bit different. How do you guys kind of work with them in terms of, from that perspective? Like, are you guys tailoring every single client that comes in, or are you guys kind of giving him more of a broad picture of here's some things that, could work for a lot of your different clients?
Yeah, a great question. And the answer is no. We are not dealing with the individual clients. They are the face, they meaning the advisor is the face, the relationship manager, the translator of objective to solution, investment solution. So they definitely are equipped to do that. The way the platform, the composition of the platform is put together, Skylar's portfolio relative to Michael's portfolio will look very different because of the number of different types of things that are on there and that allow them to build portfolios in a customized fashion. This is not a plug and play. Everybody's got to fit into one of these 5 models. That's not what it is. You can custom build. The way the technology works, it's UMA. If you're familiar with that concept, it's UMA technology under the hood. So in one trust account, $1 million trust account, they can allocate to 3 separate account managers of their own choosing. They want to have a U.S. centric, so they've got more U.S. than international. They can allocate to an income generating investment strategy. So, something that's going to blend some BDC product in with some high yield and bank loans or preferred equities or even a dividend centric equity, portfolio. So an income sleeve or allocation, all still in the same account, and they're able to use the pieces and build a completely different house for Skylar relative to Michael. But they're the same pieces, if that makes sense. It's different percentages. And again, some clients have, upwards of, I don't know, 40, 50, 60 different pieces that they can choose from, so you can imagine, I'm not a math guy, kidding, I am a math guy, but, lots of different combinations, obviously, that you can put together.
Yeah, that makes a lot of sense. I'm curious, obviously you mentioned relationship and partnership are very important, right? Collaboration with your clients. I'm curious how that kind of conversation happens on an ongoing basis. Is it like a monthly, quarterly check-in? Do they come to you with some different things and say, hey, go vet this out for us? I'm just curious on the dynamics internally and how that communication happens.
Yeah, that's another great question. Tyco, the business model is really, to be really clear, we're really an extension of their staff. So we want to be extremely accessible to them, and we make it that way. So yes, we have, I guess, first layer is formal quarterly investment committee meetings. If they don't have an investment committee created, working with us is going to create one. They have to have 1, 2, 3, 4 point people on their end that are going to either learn a lot or come to that table with what they know and contribute to the collaboration. So an investment committee meets formally 4 times a year. Some clients meet twice a year. We're indifferent. They're both fine from a regulatory or compliance perspective. But in those meetings, we do have, very detailed performance risk eval of all their models, their multi-asset class models, as well as single strategy managers that they're deploying client capital to. So they're reviewing that quantitative and qualitative due diligence, those 2 or 4 meetings a year. That's interaction 1. Interaction 2 is monthly. Typically, again, totally can be customized by a client. We have one client that actually needs weekly calls. Some of those weekly calls might be 7 minutes, 6 minutes, but they really touch on one of 3 buckets. We call them ISO meetings. And those ISO meetings, I is the investments. So we'll touch on any questions, prevailing questions they have on investments on the platform. Want to see, does deploying this manager or this model in this situation make sense? Is that a good use of that strategy? Tell me more about this hedge fund. Is that a good fit for this situation? We can be a sounding board, to them on the investment side. The S is sales. So, hey, I've got this situation. It's a $5 million prospect, and they're a whatever Merrill Lynch, and here's what their portfolio looks like. And again, real-time sounding board. I would position this one, knowing the platform fee structure, your advisory fee structure, you want to sell on fees. You want to position this thing on, you're going to be leaner and smarter and more tax efficient because they're all mutual funds and they're retail mutual funds, whatever it is. So maybe some sales tips or angles. Again, extension of staff. And then the O is the operations. So that's making sure that our team is working really well with their operations team. So our trading and billing, we process the billing for the advisors and pay all the managers, of course, as well. No different than InvestNet and the other platforms, that are out there. So the operations teams can talk. Are the tickets that are coming in? Are we finding issues with the communication, whatever it might be? Bringing them up to speed on the technology, addressing any of those sorts of issues. So, investments, sales, operations, those, like I said, they can happen once a month. Some happen once a week. It really is tailored to the clients so that we end up leaving the client feeling, the firm feeling like we're part of their team. That's the idea.
Very cool.
Yeah.
Joe, any final thoughts on the RIA side? I'm curious. I'm keen to move on to the institutional side, but any final thoughts for you on the RIA side of the business?
No, just say it's really a product. We don't have a sales force, so we're word of mouth for sure. We will be bringing on a sales force for sure. We definitely have our feet under us at this point, but it's selling itself. We think we're right place, right time, and super excited about it. That's all I'd say on that front. The Tyco business.
Absolutely.
Right.
Awesome. So, talk to us a little bit about the institutional side of the business. What type of institutions you guys normally work with, and talk to us about the service that you offer on that end.
Yeah. So the institutional business, again, that's the cornerstone of kind of what we're doing. It has been since 2012. So I'd say that's 95% traditional, non-discretionary consulting work. So very similar business model, honestly, to the Tyco business, where we meet with, typically it's a finance committee or a board, where we're reporting on the investment program risk, performance, providing detailed performance attribution, peer group ranks of their program, of their managers, very detailed performance reporting package. We risk model up front and construct and build out formal investment policy statements for each client. So each client portfolio we walk through with the client specific assets to be included in the risk modeling and the portfolio construction process up front. We translate that to an investment policy statement, and then we take the last step of looking at the managers and the allocations that they have in place, coming back with an eval of those legacy managers. A lot of cases, keeping most of them, honestly, unless there's just, poor management, at play. We don't come in and blow anything up. We're non-discretionary, but we then, if there are, let's say 3 of 12 managers that we think you can do better, they're overpriced, they're unwilling to budge on fees, their performance has been weak, whatever the reason might be, the 3 key people just left, whatever it is, here are 3 replacements that have made it through our screens, our due diligence, that are in our recommended stable of managers. And that speaks to both the traditional side as well as the alternative side. We maintain recommended stables and then bench players. So kind of a monitor plus status of products, strategies from all around the world, right? So part of the reason we're in downtown Chicago is that we're just in the foot traffic of a lot of institutional consulting firms are located here. So our front door is a revolving door of, portfolio managers or product specialists that just do rounds, and where they're talking about what they do, how they manage money, what their competitive edge is. And so we're doing, generally about 10 to 15 of those meetings. Obviously now a lot of those are on Zoom as well, but 10 to 15 of those meetings on average every week, So so it constantly, we want that traffic, we want that deal flow, we want to maintain those discovery sessions, those dialogues to feed the institutional practice with good product, constantly, and keeping tabs on what teams are where and why and how they're doing is a huge part of what we do, every day. So we marry that with the macro work. So of course, our research on the macro side is consuming, bank credit analyst, Alpine Macro, Strategist, Bespoke, tons of different kind of independent research outlets, and of course we're showered with Wall Street research, as well. And so there's buy side
Yeah.
research. Yeah. So,
And these are typically like endowments, pension funds. What other type of clients you guys working with?
yeah, mostly endowments and pension funds. There's some litigation trusts that are technically institutional that we work with. A couple of family offices as well. So we have family offices that have internal scaffolding set up to do direct deal investments as well. So we have board observation rights in conjunction with a few of these family office investors where we're doing direct deal due diligence, most often in a co-investment capacity. So we really don't want to be involved in a direct deal unless there's a sponsor, involved in the business already, because they're the grown-ups with the operational, the financial wherewithal to really affect the change. Hopefully, it's not our job, but we could certainly see opportunities that are compelling fundamentally, that have the right management and expertise in place and financial wherewithal behind them to be able to potentially result in some interesting, outcomes, from a direct deal perspective. And then there's a lot of GP/LP fund structure on the alternative side, on the private market side, as we've done a lot, have been active in private credit since way before it became the flavor of the month in the last several years, by the way. It's something that we've been active in for quite some time. Actually makes us a little nervous, a lot more of a crowded area of late than what it has been historically. But private credit, private equity, growth equity, venture capital, kind of across the board, knowledge and expertise to allocate client capital there. And like I said, real asset strategies of various types. We don't do much just because our client base there is what I call small market. And these are generally 50 to maybe $700-800 million pools. A couple of the family offices are north of that, but that's small market institutional business. So we're not getting too esoteric in terms of the types of alternative product, or too niche in terms of the types of strategies that we're allocating to. Not huge fans of, I never really have been huge fans of kind of the hedge fund to funds product, to be really clear there. We're really comfortable creating, a diversified, approach of, 3 or 4 multi-strategy or complementary type hedge fund strategies that give the client what we think is some good exposure. So that is one thing on the hedge fund side I'd probably mention.
Yeah, that's definitely helpful. I'm curious, Joe. Obviously, you're touching a lot of different firms and conversations and strategies, GPLPs, institutions, RIAs, being that sounding board for boards, right? For coming in and saying, here's kind of what we're seeing. Here's our thoughts based on sales approach. On the alternative side, I'm sure it's come up in boardrooms like, hey, the ETFs are approved for digital assets now. We're thinking about some of this. Is that happening on the RIA side, the institutional side? I'm just curious, from your lens, what comes your way in that regard?
Yeah, I mean, honestly, on the institutional side, not much, really not much. And I think the reason for that is because we approach it and I defend this, I think, we approach it from a risk budgeting perspective, and how much of the risk budget is eaten up by most of the digital asset, strategies and asset, opportunities that are out there is just, a difficult thing to reconcile, just because of the volatility that they introduce. It's not to say that they're not fundamentally, making sense from an investment standpoint. So, but I think it's a tougher sell institutionally. On the RIA space, definitely get asked about that. We don't have any product out there on any of the platforms, plural, again, they're all custom, that really cater to the digital asset space right now, but it's not to say that we won't. I think it's one of those things that we've done, we've done some white papers, some research papers. I've done a lot of work on it. I haven't personally myself. Our director of research has driven a lot of that, keeping that type of content out and really surveilling the landscape. But I know the evolution of digital assets into very investable format, very recently actually, is definitely going to put it only more and more on the radar.
Yeah, definitely. I think to your point, conversations I've had, even just on the pensions and endowments, they talk about it, but obviously they've not adopted it as of yet. But RAAs and family offices, it seems like the conversation is more so there, right?
I'd agree. I'd very much agree.
It's great. Appreciate the feedback.
Yeah. What are some of the allocation trends that you're seeing, from some of your clients in terms of maybe like types of funds that they're investing in? Obviously you mentioned like private credit, but give us the full picture. What are like some of the high level trends that you're seeing out there?
Yeah, I mean, I always hesitate a little bit on trends just because I just don't like the word. And if it's a trend, it's actually probably maybe something to fade, not lean into. But private credit might be in that camp. I think private credit is an interesting one because it's definitely a trend. It's because it gets more ink now than it did 15 years ago. We've been, like I said, we've been active there for a long time, and I think it's a really defensible asset class, a terrific add to a program. That said, as with any asset class or space in the capital markets, there are firms that are more asset gatherers, and there are firms that are more alpha and fundamentally focused. So I think the key there with trends and again, private credit probably is the one that we're probably asked about more so than anything else of late. Being able to discern really strong GPs, really strong firms that have demonstrated through multiple cycles the ability to perform well and exact recoveries when the instance inevitably comes in the private credit landscape specifically is super important. So being able to know and be able to discern kind of good from bad or stable from flyer, I think is really important. I don't know. I think in terms of what we're asked about, I'd say definitely private credit would lead the pack there. Nothing really in the hedge fund side. That's I think hedge funds in general are sort of mislabeled, honestly, in the industry. They always get bad press when they lag the S&P 500 when the S&P 500 is up 25%. Well, of course it lags in 25% of the S&P 500. It's a hedge fund. So people don't understand, net exposure, and you need to do some math to come up with where a hedge fund, generally should perform.
Anything on the CTA side?
CTAs, yeah, I think that's one of those things that we've always struggled with, honestly. I don't think we have any dedicated CTA allocations. We have complemented in the past, certainly we've used CTAs, managed futures, CTAs, both. But we don't have any current allocations there right now. I love what they can do to a portfolio, but it seems that every time we've allocated to CTAs or managed futures, they end up being just a weight around your neck for a long period of time. And it really strains a committee to have to look at languishing returns when public liquid long-only markets are doing relatively well. But, that's not why it's in the portfolio. It's in the portfolio. It's a diversifier, of course. So we understand that. It's just, we found it difficult to, sometimes difficult to manage on the institutional side specifically, difficult to manage the client, expectations, difficult to manage the client, ability to withstand sometimes longer periods of languishing, not horrible, but just languishing returns, relative to the liquid public markets. So,
Yeah. I mean, maybe until the last year or so. I mean, it's been a decade of pain.
Yeah. But
commodity markets.
Well, I mean, 2022, great example. Probably the worst market I've ever seen. I mean, that includes, the tech bubble burst in 08, 09, by the way. 22 was just god awful because nothing worked.
Yeah.
Bonds were crushed, beyond worse than they ever had done. And equity markets were down, 20+%. So, you have a year like 2022 and there were ample, CTAs and managed future strategies that paid dividends in spades that year, but it's always that year, but the other 8 years are again, it's a grind. I think that one in particular.
Absolutely. Yeah. You mentioned managing expectations, Joe. I think, in the current economic climate we're in today, I mean, as you have those conversations, I'm curious how the conversation is about managing expectations in the current, mandate of what they're looking to do. And then obviously where things are at, industry wise and economy wise.
Yeah, that's where, I mean, that's kind of the cyclical cycles that we all ride through. Institutionally, it's easier because it's generally not their money.
Right.
So that is a big differentiator, and it's not their business on the line. So institutionally, it's always refreshing to work with institutional clients as a great reminder of, you win the investment game by focusing on the long term, despite the noise that's right under your nose. And it's a lot easier to do institutionally, but the fact that investment committees can kind of stand on the edge of Lake Michigan out there and let the waves lap up against their ankles, as I like to say, but their eyes can stay on the horizon a lot easier and not get distracted by kind of the waves lapping up against their ankles there. And it's much more difficult to manage those expectations in an RIA or an individual, family type of a construct. So, but it is our job. I mean, as consultants, or if you're an RIA, an investment advisor, it's overwhelmingly, I think, your job to do your best to, allow that client or encourage that client to stand at the lakefront and keep your eyes up, so that you discourage, reactionary behavior, which is always the downfall of bad investing, truly. But that's part of what we like. I mean, that's sort of the, the psychotherapist or whatever it is, the counselor role that a lot of leaders do play,
Absolutely. Yeah. Trying to help them with that emotional response when things go awry in certain cases, or others that built up apprehension, like, hey, let's get them more of an institutional mindset. And this is how we would think about it. But it makes a lot of sense.
No doubt.
How do you see the financial markets evolving over the next decade?
Decade. Decade.
Take whatever time frame you want if you got a better outlook.
Short term and long term. I'll give you short term and long term. I mean, short term, we actually do stamp. I mean, our investment committee stamps kind of a short term 3 to 6 month views formally twice a month, when we get together. So we stamp those views really for rebalancing guidance for our consultants to work with clients, so overdue cash deployment and that kind of thing. So we do stamp short term views. And longer term views in the context of really intermediate, which is more like 18 months and beyond, 2 years in that neighborhood. And when you look at the latter, the kind of the intermediate term, we are a little bit concerned, right now. So we've been guiding clients to remain neutral relative to their equity targets for quite some time, including, the back half of 23 when everybody was forecasting recession. Back in August, September, October of 2023, there were, the majority of economists were predicting recession. And we never really got on that train at all. And we kind of stayed the course there. I think one of the things when you look out 2 years, though, you have to acknowledge that, where equity markets are right now, how restrictive policy is, and probably most importantly is our view on the consumer and the health of the U.S. consumer as it pertains to what we're seeing in the labor market, early signs of clear deterioration of demand for labor. And that's because that's been really the backbone of what's been generally kind of upside surprise economic growth over the last, 18 months. We see kind of weaker knees, honestly, with the consumer on that front. That in addition, the labor market, in addition to sort of a weakened balance sheet, as well. Savings rates have come down from like 6% down to more like a 4%. That can't be sustained forever. The pandemic era, stimulus is largely burned off as well. So that fueled a lot of goods consumption. And that's one of the things that we feel is very supportive, obviously, looking back. And it did, kind of bolster our more constructive view of risk markets. But looking forward here, when you look at the balance sheet of that consumer and the trajectory of the labor market and the fact that growth numbers are starting to decelerate, clearly, it's kind of like, okay, let's just acknowledge what seems like a decel cyclical trend. And when you look out 18 months, you have to acknowledge that. So that's our glass half empty, view. When you go out 10 years, I mean, we feel great. Always feel great. Always feel great 10 years out, I don't know. I think there's only been one time and that, at least in my career, that we've had a negative return over a 10-year period, and you guys know when that was. That was 2008. That was because of the draconian drawdown that we saw. So yeah, 10 years, equity markets. I mean, I don't expect multiples to expand over the next 10 years necessarily, because we're kind of, a little bit top heavy on the multiple front right now, but you got to think, fundamental earnings growth is going to be relatively sound economic growth over that time period. Longer term, we feel good. The other thing we feel good about is bond yields. Starting bond yield right here, we're sitting here at 4.25 or whatever we are today. I mean, that feels pretty good. When you're sitting at 4.5%, 5% bond yields, that feels good. When you look out 10 years, and that's, by the way, that's just normal. It's funny. All of us, got accustomed to zero interest rate policy, and the long-term average yield on the 10-year bond is probably close to 4%. I think, maybe 4.25. And guess where we are? Kind of at average. It was just a little bit of pain getting there.
Absolutely. One other thing I'm keen to talk about is you guys have this mantra, guilty until proven innocent. Tell us a little bit about that, where that comes from.
Guilty until proven innocent. Yeah, that's something we've kind of approached a lot of the alternative investment landscape. And this is, again, an alts podcast. We've approached the alternative space that way because it's probably been the right way to approach it. I mean, when you're looking at, propositions that are very expensive, that's a check mark against. When you're looking at, strategies that have less than optimal transparency, that's also a check against. And then lastly, and in some cases, you've got a propensity for fraud. So fees, transparency, and higher potential, for fraud. All three of those are why that's not a new thing. We've always approached alternative investments, broadly speaking, with a guilty until proven innocent, verdict until, we feel that the due diligence process is taking our comfort level much higher, So yeah, kind of where that came from.
That's great. Yeah. Excellent.
Joe, and anything you want to touch on that we haven't touched on yet?
I don't think so, guys. A good walkthrough our companies, plural, Taiber, Kosmala, and Tyco, what our value proposition is on both fronts. The Taiber, Kosmala, I didn't touch too much on that. I mean, I just think institutional, non-discretionary consulting firms have almost all been wiped from the face of the earth due to consolidation. There's not a lot of firms that have been around, for a long time, at least, remaining out there. A lot of the big insurance companies and the like, obviously, have gobbled a lot of those up. So it's exciting still to be playing in that sandbox institutionally. And we think there's a lot of competitive advantages to remaining independent, and then that bolt on to Tyco, and that industry, and taking what we're doing at Taiber, Kosmala and applying it to that segment of the industry is just, again, really exciting from a growth standpoint. So I think that's a good wrap.
Awesome. Well, Joe, this has been a lot of fun. Really appreciate you joining us. Appreciate the insights. Where can we send people to connect with you and learn more about both your companies?
Yeah, so there's the World Wide Web, I suppose, would be a good way to do it. TaiberKosmala.com is our website for the institutional business, and then TycoAdvisor.com is where you find the the RIA OCIO space. Phone number 312, old school guys, 312-300-4781, Chicago.
Excellent.
Love it. Got the 312 number.
That's great, Joe. We'll make sure to include all that in the show notes. This has been great conversation. You mentioned, obviously, this is all podcast. We also appreciate alternative perspectives, even on the traditional markets too. That's definitely helpful for our audience as well. So we definitely appreciate that.
Happy to.
Awesome.